Good morning everyone. Today we are starting the new chapter. Chapter name is Portfolio Management. So, what is the meaning of portfolio management? First we will understand. After we will start this chapter questions. ठीक है? So the first term is portfolio. What is the meaning of portfolio? Portfolio means basically a group of securities and investment. What is the meaning of securities now? Securities includes shares, bonds, units of mutual fund, derivatives, etc. So portfolio basically means a group of securities and investment that is we can call it is portfolio. Why ICI is introduced this topic in your syllabus? The chapter name is portfolio management. The reason behind introducing this chapter in your syllabus is the objectives of portfolio management is to maximize the return of portfolio. Without this chapter you can't understand how to maximize the return of your portfolio. Your portfolio will include many shares, debentures, bonds, mutual fund units, etc. So the main target is to maximize the return of your portfolio. And second objective is to minimize the risk of portfolio. If you want more return, then there is more risk generally. In practical life you can consider that in anything you want you are getting more return, then you are getting also more risk. For example, investing in Adani shares will give you more return, but at the same time it will give you more risk in Adani shares. So where to invest, how to maximize, how to equalize risk and return, that is we will study in this chapter. So I have categorized the portfolio management chapter into two parts. First part is basic part and second part is advanced part. So basic part, you can say these are easy things which you will learn in easy way. So the basic part we have 5 parts divided. First part is return. What is return? We will learn. Second part is risk. What is risk? How to calculate risk? We will learn in future. Third, coefficient of variation. What is coefficient of variation? Without understanding coefficient of variation, you can't go with other chapters. So first of all we will start this chapter because there are many basic things which you will understand in this chapter only, and it will also help in other chapters also. So fourth part is correlation. What is correlation? We will learn. Fifth part is beta. What is beta? How to calculate beta? We will understand. And second part of portfolio management is advanced part. Here we will learn models. So first is characteristics line or regression line. What is the meaning of this? We will learn in future video lectures. Second is capital market line. Third is capital asset pricing model. Fourth arbitrage pricing theory. Fifth is Sharpe model. And after reading basics, after reading advanced, we will go to some miscellaneous parts. First is Sharpe ratio, second is tenure ratio, third is Jensen alpha, fourth is systematic and unsystematic risk. So after reading all basics, advanced and miscellaneous part, this chapter will over. So in this chapter we will learn only these things only. You can understand that it is the summary part. If you understand all the things, the chapter will get over. So today we are starting our first lecture with the first concept, that is called return. We will also solve at the same time practical questions of your ICI module also. So first we will learn formula of return. After we will solve questions so you can understand in a better way. First is return. So what is the formula of return? You will have to learn. So if you want to calculate return in rupees, then you have to use this formula only. The formula is D1 plus P1 minus P0 divided by P0 into 100. What is D1, P1, P0? We will learn in future when we solve questions, practical questions. Now return is, when we calculate return, we have to see whether the data given in question is belongs to past data or futuristic data. What is past data? What is futuristic data? We will also understand when we solve practical questions. In this lecture only we will solve practical questions so you can understand in a better way. So return, when we have to calculate return in rupees, we will have to use this formula, and when the data given in question belongs to past data, we will use this formula. When the data given in question belongs to futuristic data, how to identify the data given is past data or futuristic data, we will also learn in the same video only. So if the data given in question belongs to past data, then we have to use this formula to calculate return. So the formula is x bar equals to sigma x divided by n. And when the data given in question is futuristic data, we will have to use this formula, x bar equals to sigma px. Don't worry if you are not understanding this. If you are getting confused, then don't get confused. I will solve of your ICA practical question. So it is the question number 1. You can note down the page number 6.64. So you can. So the question it is the practical question number 1. Question 1 is, a stock costing rupees 120 pays no dividends. The current price of stock is rupees 120. ठीक है, the current price है rupees 120. The possible prices that the stock might sell for at the end of a year with the respective probabilities are, means in future if we sold at the end of a year, today the stock price is rupees 120. If we sold this share at the end of first year, then the probability given, means it is futuristic data. Earlier I have told the data can be past data or futuristic data. So you can understand that the possible prices, it means the prices have not occurred in the past, it will happen. There is a probability that the prices of stock will be 115, of probability 0.1. If the price is 120, if the price will be 120 at the end of a year, this probability is 0.1. If the price at the end of a year is 125, then the probability is 0.2. If the price of stock is 130, then the probability is. So you can understand this part. Okay? Now we have to calculate the expected return. Now we are starting this question. If you have any query, you can comment on my YouTube channel. So we can use formula. We have to calculate expected return. So first we will use the formula D1 plus P1 minus P0 divided by P0 into 100. Now we will make working note. The possible prices can vary, so we have to calculate accordingly for each part. D1 means dividend. Here in this question it is given that there is no dividend, so we can consider it 0. P1, it is the future price. So future price, the stock may sell at the end of a year. Possible price at the end of a year, it means it is P1. Future price, you can say 115 minus P0, current price of stock 120. 115 minus 120 divided by P0 into 100. So here it is 4.16 percentage. You can calculate on calculator. So it is the first part. Now second possible price is 120. So we have to calculate for each part. 115, 120, 125, 130, 135, 140. Working note number 1 to 6. It is the P1 means future price, the possible prices, minus current price. Current price it is given 120 only, divided by P0. Into 100. It is given in formula. So you can calculate this on calculator only. So it will second 0, third answer is 4.16 percentage, fourth answer is 8.33 percentage, 12.5 percentage, 16.66 percentage. Here if you have any query, then you can comments on any query. If you have any question, then you can comments. I will solve accordingly. So it is the expected return percentage. If the possible price at the end of a year is 115, then we will get negative return of 4.16 percentage. So you can understand accordingly. Now we have to calculate the expected return. So now we have to apply the formula. The data given in question is futuristic data. How to identify the data is past data, futuristic data? Here it is given the possible prices. It means the prices have not occurred yet, it will occur in future. So what formula we will use? X bar equals to sigma px. This formula we will have to use. The price given in question is futurist price is 150, maybe 120, 125, P1 130, 135, 140. Now the probability also given in question, that the price of 115 will occur of stock. This probability is 0.1, 0.1, 0.2, 0.3, 0.2, 0.1. This is given in question price and probability. We have to calculate Px. X क्या होता है? What is the meaning of X? It is X, expected return. We denote this expected return by small x only. So you can write down 4.16 percentage or 0.416. You can write in any way, 4.16 percentage or remove percentage. Second is 0. Here it is negative. Please note it. 4.16 percentage. We will remove percentage sign. 4.16 divided by 100. You can write in any way. If you are getting confused, then we will write only percentage, 4.16 percentage. If you are guys getting confused, then we will write only in this way. Don't get confused. 12.5 percentage, 16.66 percentage. Now what we will have to do, px, p into x, 0.1 into 4.16 percentage, it will be 0.416, 0.2 into 4.16, 0.832. If there is any calculation mistake, you can solve accordingly. The answer will get correct. 2.499, 2.5, 1.666. Now add all these px. It is 7.081. The answer will come in percentage. You will calculate in any way, in any method, but the answer will remain same. Take it. Okay. The last answer we want is in percentage. It is 7.081 percentage. So the first part is calculate the expected return. The answer is 7.081 percentage. Second part is calculate the standard deviation of returns. First, we will understand what is the meaning of standard return. Standard deviation. What is the meaning of standard deviation? We will understand. You can simply call it is the risk. We have to calculate standard deviation in simple form. You can say it is risk. So now there is how to calculate risk. For this we have to check data, whether the data given in question belongs to past data or futuristic data. In both the cases, there is different formula. In past data, there is a formula you can use for standard deviation, that is risk is sigma x square divided by n minus x bar whole square, or sigma x minus x bar square divided by n. In futuristic data, we will use formula standard deviation equals to sigma px square minus x bar whole square, or sigma p x minus x bar whole square. You will have to learn formula. There is no other option. There is no shortcut. You will have to learn formula, because this chapter belongs to formula chapter only. Another name of this chapter is formula chapter. So now we will have to calculate the standard deviation of returns. We have checked that the data given in question belongs to futuristic data. How to identify the data given in question is futuristic data? You can note there is a line, the possible prices. It means this data belongs to futuristic data. Now we will consider question number 1, second part. Standard deviation. You can use any formula, the answer will remain same. Standard deviation equals to sigma px square minus x bar whole square. In earlier first part I have calculated the x. You can check that. First part is minus 4.16 percentage, second 4.16 percentage, fourth 8.33 percentage. We have calculated this in first part. 12.5 percentage. Sixth is 16.66 percentage. The probability it is given in question 0.1, 0.1, 0.2, 0.3, 0.2, 0.1. Now we want px square, means first we have to calculate px. Earlier we have calculated px and sigma px, it is the first part answer. You can check that 7.081 percentage, it is the first part. 7.08 percentage, it is the first part answer. Now for second part we want sigma px square, p into x square, 4.16 into 4.16 into 0.1. You have to do that in calculator. 4.16 whole square into 0.1, 1.730. Same method you have to apply in all parts. Second is 0, 3.461, 2.081, 31.25, 27.75. You can do the calculation. It is 35.001. If there is any calculation mistake, you can correct it accordingly. Now the formula is standard deviation sigma px square. It is sigma px square 35.001 minus x bar whole square. So what is x? X is security return. We have calculated in first part. So what is x bar minus x bar whole square? We have calculated in first part x bar equals to sigma px. Sigma px, it is 7.081. So I want x bar whole square. So we have to do 7.081 into 7.081. 7.081 whole square. So you can calculate this on calculator. So the answer is approx 5.90 percentage. The answer will come in percentage only. It is the standard deviation. So today in this video I have solved question number 1. If you have any query, then you can comments, and if there is any calculation mistake, you can correct it accordingly and match the answer with ICI module answer. Okay, thank you. Give your feedback so we can upload more videos accordingly. So today in this video we have learned the concept of return. You can correct it is percentage. Return, we have understand two concepts in this video. First part is return and the second concept is risk, that is called standard deviation.